Preparing for a wealth management at Wells Fargo interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to work in wealth management at Wells Fargo. I'm drawn to wealth management because it combines markets, planning, and long-term client trust. My background has built analytical discipline and strong relationship habits, listening first, translating complexity simply, and following through. Wells Fargo appeals to me because its advice model can connect investments, banking, lending, and planning around one client balance sheet. I'd focus on earning trust, learning the platform, and helping advisors deliver consistent, compliant client service. While answering, focus on your client service motivation, interest in markets and planning, relevant analytical or relationship experience, and why Wells Fargo's integrated banking, lending, and investment platform fits your goals. Question 2. How would you build trust with a new wealth management client? Trust starts before any recommendation. I would prepare on the client's situation, ask open-ended questions, and confirm what matters most: family, liquidity, retirement, legacy taxes, or risk tolerance. Then I would explain trade-offs in plain language and document next steps. At Wells Fargo, where clients may have multiple financial needs, I'd coordinate resources without pushing products. Consistency, confidentiality, and doing what I promise are what turn an introduction into a relationship. Make sure to cover preparation, discovery questions, active listening, confidentiality, clear communication, and consistent follow-through. Emphasize that trust is earned through judgment, transparency, and recommendations aligned with the client's goals. Question 3. Walk me through how you would run an initial discovery meeting with a high net worth prospect. I'd start by framing the meeting around understanding, not selling. I would ask about the client's family, career, liquidity needs, concentrated holdings, tax concerns, charitable interests, and prior advisor experience. Then I'd map assets, liabilities, cash flow, and decision makers. The key is listening for both financial facts and emotional drivers. I'd close by summarizing priorities, confirming what I heard, and proposing a follow-up plan that may include planning, investment review, or banking solutions. In your answer, talk about setting an agenda, understanding assets and liabilities, uncovering goals, identifying decision makers, assessing risk tolerance, and ending with clear next steps rather than jumping straight to products. Question 4. What does suitability mean in a wealth management context, and why does it matter? Suitability means a recommendation fits the client, not just the market view. Before suggesting an investment, I'd consider objectives, risk tolerance, income needs, tax situation, time horizon, liquidity, concentration, and overall net worth. A high-yield bond fund may look attractive, but it may be wrong for a retiree needing principal stability. Suitability matters because it protects clients, supports regulatory compliance, and reinforces the advisor's duty to provide advice based on the client's best interest. Be sure to mention client objectives, risk tolerance, time horizon, liquidity needs, financial situation, documentation, and regulatory expectations. Distinguish suitable advice from merely profitable or popular investment ideas. Question 5. How would you explain the difference between asset allocation and security selection to a client? Asset allocation is the big decision. How much goes into stocks, bonds, cash, alternatives, or other categories? Security selection is the next layer. Which specific funds, managers, bonds, or stocks fill those buckets? I'd tell a client that allocation usually drives most portfolio risk and long-term return, while selection fine-tunes implementation. For example, a 60-40 portfolio can be built many ways, but the 60-40 decision sets the basic risk profile. While answering, focus on asset allocation as the high-level mix across asset classes and security selection as choosing specific investments. Mention risk, return drivers, diversification, and client-friendly language. Question 6. A client asks whether they should be in a fee-based advisory account or a brokerage account. How would you respond? I'd explain that the right structure depends on how the client uses the relationship. A fee-based advisory account may fit someone who wants ongoing portfolio management, monitoring, and advice for an asset-based fee. A brokerage account may fit a client who makes occasional transactions and prefers paying per trade or product. I would compare costs, services, conflicts, and responsibilities clearly. The goal is not choosing the most expensive option, it's matching the account type to client needs. Make sure to cover client trading frequency, advice needs, fiduciary versus transaction-based relationships, cost transparency, monitoring, and avoiding a one-size-fits-all answer. Keep the explanation balanced and compliant. Question 7. How would you handle a client who wants to sell everything during a market downturn? I'd first acknowledge the emotion, because market losses feel personal. Then I'd bring the conversation back to the plan, time horizon, cash needs, risk tolerance, and what the portfolio was designed to withstand. If the client needs liquidity, we can address that specifically. If not, selling everything may lock in losses and create reinvestment risk. I'd discuss rebalancing, tax loss harvesting, or risk adjustments, but I'd avoid making a fear-driven all-or-nothing decision. In your answer, talk about empathy first, reviewing the financial plan, separating emotion from strategy, liquidity needs, rebalancing opportunities, and documenting the discussion. Avoid sounding dismissive of client fear. Question 8. How would you construct a portfolio for a conservative retiree who needs income? I'd begin with the retiree's spending need, pension or Social Security income, tax bracket, and emergency reserve. For the portfolio, I'd prioritize liquidity, high-quality fixed income, measured duration, some dividend or defensive equity exposure, and possibly laddered bonds or income-oriented funds. I would avoid reaching too far for yield because credit losses can damage retirement security. The key is balancing current income with preservation and inflation protection, not maximizing headline yield. Be sure to mention income needs, capital preservation, inflation risk, liquidity, diversification, duration, credit quality, tax considerations, and avoiding excessive yield chasing. Tie the portfolio back to the client's spending plan. Question 9. What role does tax-aware investing play in wealth management? Clients keep after-tax returns, so taxes matter. Tax-aware investing can include placing tax-inefficient assets in retirement accounts, using municipal bonds when appropriate, harvesting losses, managing realized gains, and planning charitable gifts of appreciated securities. For a Wells Fargo client with banking, trust, and investment needs, coordination is important because investment decisions can affect cash flow, estate goals, and lending capacity. I'd involve the client's CPA where needed and avoid giving tax advice outside my role. While answering, focus on after-tax returns, asset location, tax loss harvesting, municipal bonds, capital gains management, charitable strategies, and coordination with tax advisors. Clarify that wealth management is not just pre-tax performance. Question 10. How can lending solutions fit into a wealth management relationship? Lending can help clients access liquidity without immediately selling investments, especially when they face taxes, timing issues, or large purchases. Examples include mortgages, lines of credit, or securities-based lending. But I'd be careful. Leverage adds interest cost, collateral risk, and potential margin calls. The discussion should connect borrowing to the broader balance sheet, cash flow, and risk tolerance. Used responsibly, lending can support planning. Used casually, it can magnify downside. Make sure to discuss liquidity, securities-based lending, mortgages, concentrated positions, risk management, interest costs, collateral risks, and suitability. Emphasize responsible use rather than selling debt as a universal solution. Question 11. How would you identify cross-selling opportunities without making the client feel pressured? I'd start with the client's needs, not a product list. If discovery reveals a mortgage refinance, business liquidity need, trust question, or cash management issue, I'd explain why another specialist might help and ask permission to introduce them. The tone matters. This may be useful based on what you told me, not you need this. Wells Fargo's platform is valuable when it connects expertise around a real client problem and keeps the client in control. In your answer, talk about needs-based discovery, holistic balance sheet review, permission-based introductions, transparency, and compliance. Tie Wells Fargo's broad platform to solving client problems, not product pushing. Question 12. What compliance or risk issues are especially important in wealth management? Wealth management depends on trust, so compliance is central. Key areas include knowing the client, documenting objectives and risk tolerance, making suitable recommendations, disclosing conflicts, protecting confidential information, and escalating complaints or suspicious activity. I'd also be careful with emails, gifts, outside activities, and promises about performance. Strong compliance is not a box-checking exercise. It protects clients, the advisor, the firm, and the integrity of the recommendation process. Be sure to mention KYC, suitability, best interest obligations, conflicts of interest, documentation, privacy, anti-money laundering, complaints, outside business activities, and escalation. Show respect for compliance as client protection. Question 13. A client is upset because their portfolio underperformed a benchmark. What would you do? I'd listen first and let the client explain what disappointed them. Then I'd compare the portfolio to the right benchmark, not just the S&P 500, if the client owns a diversified or conservative allocation. I'd break down performance by asset allocation, manager selection, fees, and market factors. If expectations were not clear, I'd own that communication gap. The discussion should end with a plan, reaffirm strategy, adjust risk, or improve reporting. While answering, focus on listening, clarifying the correct benchmark, explaining allocation effects, reviewing goals, identifying errors or gaps, and setting a follow-up plan. Avoid defensiveness and acknowledge accountability. Question 14. How would you prioritize your time across many wealth management clients? I'd prioritize based on urgency, complexity, client commitments, and risk. A trade error, estate deadline, large liquidity event, or upset client requires immediate attention. Separately, I'd use a service calendar for reviews, birthdays, tax dates, and planning milestones. Segmentation helps tailor service intensity, but every client deserves professionalism and follow-through. Good time management in wealth management is proactive. Fewer surprises, clearer next steps, and consistent communication across the book. Make sure to cover segmentation by complexity, urgency, service commitments, revenue impact, upcoming events, and risk issues. Mention proactive planning and responsiveness without implying smaller clients should be ignored. Question 15. How would you approach business development as a wealth management professional? Business development is about earning introductions before asking for them. I'd focus on doing excellent work for existing clients, staying visible with timely insights, and building relationships with attorneys, CPAs, business owners, and community networks. When asking for referrals, I'd be specific about who I can help and respectful of privacy. I'd track follow-ups carefully. The strongest growth comes from credibility. People refer when they trust your judgment and client care. In your answer, talk about building credibility, referrals, centers of influence, client education, community presence, disciplined follow-up, and ethical prospecting. Emphasize relationship quality over aggressive sales tactics. Question 16. What estate planning topics should a wealth advisor be comfortable discussing with clients? A wealth advisor should understand the major planning topics enough to identify needs and coordinate specialists. That includes wills, revocable and irrevocable trusts, beneficiary designations, powers of attorney, gifting, estate tax exposure, charitable goals, and business succession. I wouldn't draft legal documents or give legal advice. My role is to ask good questions, spot gaps, help align investment accounts with the plan, and bring in estate attorneys or trust specialists when appropriate. Be sure to mention wills, trusts, beneficiary designations, powers of attorney, gifting, estate taxes, charitable intent, business succession, and specialist referrals. Clarify that advisors coordinate rather than draft legal documents. Question 17. Describe a time you had to handle confidential or sensitive information. In a prior role, I worked with sensitive financial data during a client reporting project. I limited access to approved team members, avoided discussing details in open areas, stored files only in secure systems, and double-checked recipients before sending anything. When someone outside the project asked for information, I confirmed permission before sharing. The result was a clean delivery with no confidentiality issues. In wealth management, that discipline is non-negotiable because trust can be lost instantly. While answering, use a clear behavioral. Question 18. How do you stay current on markets, and how would you discuss market views with clients? I follow firm research, major economic releases, central bank commentary, earnings trends, and market data, but I'm careful not to overstate predictionability. With clients, I'd translate market views into practical implications: diversification, duration, cash levels, rebalancing, or risk exposure. I'd also separate long-term plan decisions from short-term noise. Clients don't need a dramatic forecast every week. They need disciplined context that helps them stay aligned with their goals. Make sure to cover credible sources, firm research, macro indicators, client-appropriate communication, humility, and linking views to portfolio implications. Avoid sounding like you would make short-term predictions confidently. Question 19. Tell me about a time you worked with multiple stakeholders to solve a client or business problem. In one project, a client deliverable required input from operations analytics and a relationship manager, but timelines were slipping. I created a simple task tracker, clarified owners, and held short check-ins focused on blockers. I also summarized decisions so everyone had the same facts. We delivered on time and reduced rework. That experience fits wealth management because client solutions often require coordination across investments, banking, trust, operations, and compliance. In your answer, show collaboration, communication, ownership, and follow-through. Relate the example to working with advisors, portfolio managers, bankers, trust officers, operations, and compliance in a Wells Fargo environment. Question 20. What would your first 90 days look like in a Wells Fargo wealth management role? My first 30 days would focus on learning Wells Fargo systems, compliance expectations, the team's client base, and advisor workflows. By 60 days, I'd aim to handle routine service requests, prepare meeting materials, and understand common planning and investment solutions. By 90 days, I'd be contributing more independently, tracking follow-ups, supporting reviews, identifying client needs, and reducing administrative friction for advisors. I'd balance speed with accuracy because mistakes in wealth management can damage trust. Be sure to mention learning systems, products, compliance policies, team workflow, client service standards, advisor preferences, market views, and measurable early contributions. Show humility, urgency, and structured ramp-up. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.